Hey guys, all content discussed is due diligence gathered with aim at better understanding the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive in. The stock market today was nothing but a roller coaster, and I mean that literally in every sense of the word. The pre-market served as the part where we go up, then Jerome Powell opened his mouth and we went down only to come back up in a false sense of optimism that was met with the reality check of what awaits us, which was a massive drop. So, not account for yesterday's video since it was regarding meme stock investments and not markets. It's been a long time since we talked about has been happening. I've been meaning to make a video but haven't, so I'm going to be making this one out to be about everything you need to know about the Fed's recent changes, why we traded the way we did, what awaits us moving forward with these changes made, the anticipated risks moving forward for the market, the destabilization of worldwide economies and some really sickening news that show the barbaric nature by which the SEC continues to reward criminals and let them get away without real consequences. Let's begin with the hot topic of inflation, because Powell has transformed the Fed into the most determined force in the entire planet. Jerome Powell's sole focus right now is in curbing inflation, and they are raising interest rates by 75 basis points for a third time in a row. 75 basis points is certainly ugly and uncomfortable, but it's not even close to what's pushing markets down. In fact, had it only been just the announcement of 75 basis points, markets would have run over 2% in the last 2 hours of trading, with SPY probably moving over $400 by next week. No, what Wall Street and other market participants were eyeing for was the general stance which signals what is to come. Remember guys, we knew 75 basis points was coming, the fear was that it would be bigger. However, Jerome Powell was not shy to signal that this dreaded scenario is not a nightmare, but a reality to come if things don't start to quickly turn the other way around. This is why we saw this huge dramatic fall after SPY bounced hard after the meeting started. The cautioning of greater hikes over 75 basis points is going to cause markets to reach new lows, because as the popular saying goes, this is most certainly not priced in whatsoever. In a statement, Jerome Powell said, and I quote, "We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. Officials lifted the target for the benchmark federal funds rate to a range of 3% to 3.25%, which is the highest since before the 2008 financial crisis, and up from near zero at the start of this year. Officials are forecasting that rates could reach 4.4% by the end of 2022 and 4.6% at some time in 2023. This is a much more hawkish stance than previously expected, which is why markets went bearish. So what exactly does this mean for the future? Well, to me this signals that the next basis point hike is definitely going to be 75 points again or even higher depending on the next couple of CPI reports. Again, the main takeaway from today is the following. There will be more hikes this year and there will most likely be even more hikes, possibly even bigger, next year. The persistent high inflation is forcing the Fed to act as an unyielding force that will move whatever basis points are needed in order to ensure its ability to bring it down once and for all, regardless of what might happen. But did you guys know that it isn't just the stock market that's been stumbling down non-stop? The US 30-year mortgage rate hit 6.25%, which also happens to be the highest it's been since 2008. That's right, the average contract rate for a 30-year fixed mortgage jumped to 6.25% last week, with adjustable rate mortgages also increasing on the 5-year. The US housing market is cooling down rapidly, leading to sales declines and pressures on home prices in many important parts of the nation. What I feel nobody is talking about is that we are entering into a housing recession right now. People will think that lower home prices are going to be good for families, but that is not the case at all. That is actually going to be a full-on video I am making for tomorrow, but do note that as of right now as you are watching this video on August 21st, the stock market and the housing market are experiencing beleaguered conditions that are typical of a recession of near or equal measure to that which started in 2008, even if the corporate media will lie by changing the definition of recession itself. But what about the second biggest economy in the world then? Well, the situation in China has gone from grim to catastrophic. With the government holding their economy hostage through sanctions and over-aggressive policies to ensure another pandemic doesn't start, they have made conditions by which young Chinese people are no longer spending anymore. For those out of the loop, the Chinese economy, just like its American counterpart, both need constant spending by people in order to grow. The moment money stops cycling around, you move straight into recession territory as if you held a fast pass ticket. Many Chinese in their 20s and 30s are worried about China's pandemic lockdowns, and with such a high unemployment rate, they are being forced to make very tough decisions, resulting in young citizens focusing more in savings instead of spending. What's even more interesting is that this new frugal way of living is being made incredibly popular by social media influencers in the regions. The rise of low-cost living will harm China's economy both short and long term, because more than half of China's gross domestic product is made up by consumer spending. Chinese market research groups are saying this is the time where they have seen the most concern by young consumers. While researching this topic and putting some figures together, it appears that China is on course for its slowest economic expansion in 40 years. Their share of global trade growth will not just decrease, it will be halved over the next 5 years. Yeah, their factory output was better than expected in August, but that's because in August 2021 it was much worse because the pandemic was that much worse. We have talked about this recently as well. The nation that once innovated production and internationalization will now be subjugated to a variety of changes that will leave it in a position without the great leverage they have enjoyed for a couple decades. India is catching up along other Asian nations, and we are seeing big corporations, including Apple, begin to outsource outside of China. Because of the nature of these changes in conjunction with the rapid pace they are happening, their economy is up for abrupt shocks. Now adding to that new data showing that consumer spending, in particular with young people in their 20s and 30s, which make a significant bulk of the spending a country typically gets, their fate is pretty much sealed. Unless China can magically produce jobs overnight and change policy completely, nothing they do will be enough. This is not even touching on the catastrophic real estate, which has continued to worsen as well. With both American and European economies showing signs of serious fatigue, with the slowdowns being driven by food and energy sectors in particular, we can rationally argue that the slowdown in demand will leave China in a particularly vulnerable state, more so than the US, given their growing dependency on foreign capital and close trade tied with the United States and Europe. Let's dive a little deeper though. We know that trade remains most obvious source by which weakening external demand can impact China. Every single recession since the year 2000 has coincided with sharp declines in China's shipments to the United States. The dot-com bubble burst, the subprime crisis and the 2020 pandemic breakout have all demonstrated this fact to be true. Now, for this next portion of this video, I am going to be using data by the Organization for Economic Cooperation and Development. This data traces one country's true export exposure to another's adjusted for supply chain effects, which will allow us to estimate the quantum of the impact that several landing scenarios for the US and Europe could have on China. In the case of a soft landing, the US and European economies will slow down but avoid a recession, which is what the current Biden administration is pegging its high hopes on. In this scenario, we see China's exports to the two markets weakening, but they also avoid a contraction. In the end, their export contribution to gross domestic product growth falls by half relative to 2021 levels. This is by far the best scenario that awaits China, which isn't good by its own measure but comparatively, a God-given to the hard landing scenario, which by contrast, sees the US and European economies slipping into mild recession, causing China's exports to contract and shaving off 0.3% off gross domestic product within the next 12 months. However, there is one more scenario at play, one that not only keeps China awake at night in sweat, but also keeps Kenny and friends in fear, which is the crash scenario. This is where nothing works, everything falls apart and we go deep into a financial recession that could turn into a depression. The entire globe goes into chaos and the export shock alone would cost 1 whole percentage point of China's GDP in the best case scenario of it, and a couple in the worst of course. Now, quick caveat, this is all assuming things continue to go as they have been. Remember, a bigger conflict in Russia or a war in Taiwan or any sudden impactful change could change the numbers and overall trajectory of things, so we must keep this in mind and not take this as a foretelling of things to come with no exception. But, numbers are numbers and this is the current predicament of things to come if nothing really deviates the world one side or another. It's exactly what I have been saying for months, but now we have TVA stats to prove it all. One thing that I also want to point out is that China's financial markets will not be immune to external volatility. For example, you guys know how I have always talked about the psychological effect of fear and the anticipation of worse things to come, ensuring those things actually do happen. Well, China's financial markets are not immune to this phenomenon, which we will call recession fears given it's the most commonsensical thing to do. With the skyrocketing dollar in value, because it's bolstered by its safe haven flows, it puts negative pressure on the yuan-dollar exchange rate. There is enough evidence at the moment to suggest that yuan could see serious depreciation in coming months, and in the crash event, it losing so much value that it won't recover enough before another country's currency value overtakes it as dominant. Again, this plays into the changing relevance of China in the world as main producer. India is catching up, and other countries with better Western relations are also gabbling up their businesses. All is set to change. The world will not be the same in 10 years and most certainly change dramatically in 20, and the changes are happening now as we speak, and this is going to lead to increased uncertainty of how things play out, which of course with the inflation forces, we are likely to head into tumultuous times. Big shout out to Global Impact and Aiden Yao for their efforts in putting things together neatly. 2 important news to cover. Ken Griffin has moved to Florida, becoming the richest person in the state with a net worth estimated around $30 billion. This will not be shown in the yearly statistics presented, but the crime rate of Florida more than doubled because of this development. The second set of news, and the more depressing thing of the day if we are being honest, is the recent news that Morgan Stanley hard drives, which held sensitive client data, got auctioned off online. Morgan Stanley apparently hired a moving company to decommission thousands of hard drives and servers holding customer data, which the company later sold them in the thousands to third parties. Those devices were then resold again on internet auction sites without the removal of the sensitive data, and the firm has not even yet recovered the vast majority of the devices. Now, nothing about this oversight by one of the most criminal organizations in the world shocks me. Morgan Stanley's name is synonymous with the word crime itself. The real heartbreak here comes from the SEC, the notorious agency which somehow manages to disappoint me further even when I believe it impossible. What did the SEC do about this? Well, they slapped them with a $35 million fine, which is pennies to them. But even worse, they made an agreement where Morgan Stanley agreed to pay the fine without admitting or denying the findings in the settlement. Yeah, that's right. By doing so, they are able to free themselves from litigation in courts. You see, as I have described in the past, the SEC has a structure where when they find a firm or person criminal, they can offer them a settlement where they pay a tiny fine, but by doing so, they do not incriminate themselves. You want to know what the cherry on top of this is? Because these fines are configured and assessed as settlements, they can actually be written off as business expenses, getting a nice little tax deduction on top of it. The grotesque, putrid nature of the way things works in Wall Street with the SEC and the judicial arm could be described as satire in a comic book. It's so shockingly absurd you would think it's literally a joke of how things could be in a societal dystopia, but these are the people we have to confine with. This is why every GameStop and AMC share I buy is never enough. I want them all bankrupt and gone. With that said, let me know if you guys like the video. I'm looking forward to posting more content soon talking about housing markets. I adore you all. Have a fantastic day. Join my Discord already and make me a happy man and to the moon.